So next up, we're going to talk about RSIs and divergences. So traders can use the RSI to predict trend reversals and to identify bottoms or tops in a market. This can be found by looking for bullish and bearish divergences. Now, divergences are conditions where the actual price of the asset and its RSI value move in opposite directions. This is similar to the MACD video, but instead of looking at the MACD, now we're taking a look at RSI and how that will produce divergences. So bullish divergences occur when the RSI rises while the price of the asset falls. This indicates that buying pressure is increasing even though the price is falling. Selling pressure is starting to weaken. Now, a bearish divergence, this occurs where the RSI falls while the price of the asset rises. This indicates that buying pressure is weakening. Buying momentum is lowering, even though price is increasing. We're starting to see that maybe the price increases are unfounded or not supported by the buying pressure. And if buying pressure is weakening, selling pressure will soon fill that void. They will soon increase. So here is our bullish and bearish divergence cheat sheet. There's four main types of divergences. Regular bullish, hidden so there's regular bullish and bearish divergences, and there are hidden bullish and bearish divergences. We'll go through each one quickly. So in a bullish situation, in a bullish divergence, I should say, we are in a downtrend. It's a confirmed downward movement, right? Price is forming a low, it forms a high, and it forms an even lower low. At the same time, the RSI in this case, our indicator, is producing a low, a high, and even higher low. So we're looking for lower lows in price and higher lows on the indicator occurring at the same point. And remember, we want to align these up. Right now, this isn't actually lined up, but on our chart, which we will look at in a little bit, these points will be lined up. We'll see a lower low in price in the indicator and a lower low in price and a higher low at the same time on the indicator. Bearish divergence. In this case, price is moving upwards. We're in a confirmed uptrend. We're seeing highs, low, and a higher high. At the same time we're seeing this higher high in price, we're seeing a lower high formed on the indicator, on the RSI, right? We have our high, our low, and a lower high, right? So indicators are coming down, price is going up. That's giving us a signal that the buying momentum is weakening, and because if it wasn't weakening, the indicator would have produced a higher high as well. Now, hidden divergences are flipped in a sense. So let's say price, we are in our uptrend in price. Price forms a low, a high, and then some sort of higher low. At the same time, the indicator is pointing down. We're seeing lower lows on our RSI. And this is an indication, well, selling pressure should be going down. Buying pressure should be weakening if the indicator is going down, but at the same time, price is actually going up. So that's an indication that price is still going up, and this is actually undervalued, right? Because if buying pressure is going down and price is going up, that means there's much more room to go. Now, the other side of things, we have our bearish hidden divergence. In this situation, we're in a downtrend. Price is forming lower highs, while at the same time, the indicators are forming higher highs, indicating that buying momentum or buying pressure is increasing at the same time that the price is decreasing, price is falling. So this is an indication that prices will continue to fall, because if the indicators are showing higher highs, buying prices are increasing and prices are still falling, there is still more room to come down. Here are some examples of how this plays out on a chart. So in this situation, this is our bullish divergence. This is Solana, the 1 hour chart. Price makes lower lows, noticeable lower lows from here to here. From, let's say, 135 to a low of 115, yeah, about 115, give or take. And at the same time, the RSI makes higher lows, right? The RSIs are starting to rise. We fell below this 30 level, and at the same time, we come back up, and we fall back down to the 30 level, form a higher low, and quickly breach back up this 30 level. So this was a great signal in multiple level and on multiple perspectives, not only on the bullish divergence perspective, but also on the crossover from below 30 to back up to it. We could also make the argument that price came to 30, did not actually fall below it, and actually the 30 level was held as like a level of support, right? And overall formed this higher low. The 30 level held much more than it did back on the 20th, as we see here. Overall price would come back up. Looking at the other perspective, here is the RSI bearish divergence example. Price is making these higher highs, while at the same time the RSI is making lower highs, indicating that buying pressure is weakening and that the general buying activity has a downward trend, whereas price is still trending upwards. So this is on Bitcoin, US dollar on the daily chart, and this was actually in the first 2 quarters of 2021, going from January up until April. Here we see Bitcoin going from this new established high of about 42K and breaching past and forming this new high of about 64K. At the same time, we see the RSI continuously failed to produce a higher high compared to the one established in January. Buying pressure was extremely high. Buying activity and momentum was extremely high. This goes to show you that even though it's considered overbought, right? This was considered overbought. Price can still go upwards, right? And price did continue to go upwards. Now, signs of this playing out could be found when we want to turn to market structure. We failed to produce a higher high, right? We came up, we saw a high, a low, a higher high, a higher low, a higher high, a higher low, a higher high. If the market was going to continue to move upwards, we would have formed another consecutive higher low to continue this trend, but we didn't. We saw a failure to do so, a weakening of buying pressure, selling pressure mounting at this point, overall producing a lower low compared to the previous low, and then a lower high compared to the previous high. So even if you wanted to wait for even more confirmation on any of these, which we always want to wait for confirmation, we don't want to jump the gun, but at the same time, timing and entries are important, so we have to find a balance. Here, it was very clear, especially after this one. Price came down to the 30. Sorry about that. Price came down to the 30 level, bounced back up to the 50. Now, at the same time that it bounced back up to the 50, it failed to meaningfully progress back to 70 like it did many other times and continue this trend of lower RSIs. It also failed to produce a higher high. So this is multiple areas of confluence, multiple areas of evidence that, well, there's a significant market reversal underhand. And overall, we could have just drawn these trend lines, right? Drawn a trend line from the candle, lining it up with the candle that we saw our high to another high, and at the same time, our extreme high on the RSI to our lower high observed on the RSI, and just following the trend lines, right? And just lining things up and saying, well, we failed to produce a higher high here. We continuously keep making these lower highs. Something's got to give. A bit more on trading RSI divergences. So here we want to look for instances where a price movement of an asset and the RSI move in opposing directions. Price has higher highs, RSI has lowering highs, vice versa for the other divergence style. Now, in a downtrend, you can identify where selling pressure is weakening to spot trend reversals. In an uptrend, you can identify where buying pressure is weakening to a spot trend reversals. Same. Especially this one. This was the clear example on Bitcoin that we saw before, where we saw this uptrend. We identified buying pressure was weakening. The RSI were forming consecutive lower highs and failed to breach past that trend line. And then once the uptrend finally started to break down, right, we saw the market break down. It failed to produce another high higher than 64K. We already had evidence from the RSI forming lowering highs. That was a key area to spot the trend reversal. Now, with this, you can draw a trend line on the RSI indicator to pinpoint when its trend is broken. This can be useful when confirming breakouts or breakdowns out of candle patterns, and it can indicate trend reversals if the RSI breaks support and resistance areas. Also, it can be helpful to find buy and sell opportunities within a market trend. Now, note, you want to make sure that you're lining up the beginning of each trend line with each other. Divergence trend lines made on price action charts and indicators should line up with one another and begin/end at the same points. Here's a tip: use the magnet tool. That way you can lock on to each one of those candles. If you're not sure how to do that, please check our video on TradingView. So here's an example of a trend clearly labeled on the RSI. So we were able to draw our trend line on the RSI, and we see that we're seeing these consecutive lower highs. At the same time, we're seeing price continue to fall, right? So it makes sense. We're seeing this bearish movement, a bearish pattern, oversold conditions on the RSI, failure to breach, even really meaningfully breach past the 50 level. Price comes down, we're starting to see, really, if the trend continues, we would continue to fail and even form lower highs on the RSI over time. Here we see finally a break past this trend. We drew this trend line, we could break past this, and this was met with also a breach in price action, right? We're starting to see some sort of rally here, or maybe an overall market reversal depending on the situation. We don't have more context to put this in, but even just looking at this screenshot gives us the idea that we can draw trend lines on our RSIs. That way we can measure, all right, well, if we breach past here, maybe this could have formed some sort of bottom. We didn't. We fell back down. We were rejected. We come back up again, and we finally breach past this. What's interesting here is that on both of these situations, we formed this absolute bottom on the RSI. It comes back up. It forms another bottom. So this could have been potentially a good trade setup, right? It even in the chart itself, there's some almost a bottoming pattern, but it was still too early, right? We were rejected one more time. Price comes back down one more time, still forms a higher high compared to this high, and overall finally reverses to the upside. Now here is the same on in reverse, I should say. Price is using this trend line as support in this case, or I should say the RSI is using this level as support. It's slowly forming these higher lows and continuously forming these higher highs in the RSI pattern. At the same time, price is trending upwards. Well, what could give me indication that price is going to reverse? Well, here is where we see the first instance of price breaching past this trend line that we've seen for many consecutive candles at this point, right? Overall price is trending at this point. The RSI is trending at this point until here. We see the breakdown, and at the same time, this is met with a breakdown in price. And what's also noticeable is that even after breaking past this level, RSI continuously failed to breach past the level that the trend line was broken. So this was a significant level, in at least in this recent trend on the RSI, and it does line up with what is going on the price candle charts as well. Finally, some downsides of RSI indicators. So RSI divergences may not be as reliable during strong market trends, such as a severe uptrend or a severe downtrend that we saw on that Bitcoin daily chart, particularly from January to about April. We saw multiple divergences, but the market was so strong. We were continuously producing those higher highs and higher lows, and what we were waiting for was that breakdown in market structure. And then it's like, all right, well, we see the concrete evidence that there's a breakdown in market structure. The indicator, the RSI, supports that theory that there's going to be a trend reversal coming soon. Now, another consideration is that false signals could be displayed, such as in a downtrend where a bullish divergence could be shown before an actual bottom is reached. Going along with this, we also want to wait for candle closes depending on our indication, right? So let's say we were spotting out some sort of bullish divergence on the 4-hour chart, right? Price formed a low, formed another low. At the same time, the RSI is forming a high, and then maybe a low, and then an even higher low, right? We're seeing these ascending lows in the RSI. What we want to do is typically, I would say, to avoid looking for false signals where maybe it looks like it's setting up to do something and then it continues to dump more. Wait for the candle close, right? So if you have 30 minutes left on your candle close, you're basing your trade idea on this specific candle at this specific time period on this time frame. Wait for the candle close, wait for confirmation to enter on the trade, even if you think it's the absolute bottom. That's the best theory. In this could really vary. If you're waiting on a 30-minute chart, you got to wait maybe another 10 minutes. All right, that's not a big deal. If you're trading off of the 12-hour chart and you have another 6 hours you have to wait, well, you're going to have to wait. And that's part of the reality of trading. It's being patient and doing whatever you can, especially being patient, to avoid false signals and false moves. Another thing to consider is that RSI divergence strategies may be more accurate in a range-bound environment where price bounces between an identifiable top and bottom, and faint trends are more prevalent. So let's say we're range-bound between some sort of predetermined high, predetermined low, and price is zigzagging away in a set range. The RSI could be more accurate in these types of situations and can provide even more reliable signals. And it's always encouraged to use RSIs and any other indicators to add to your traded ideas based off of price itself. This means looking for market structure, looking for horizontal support and resistance levels. This should be the basis for your trade idea, where you let the indicator add to it.